bring in Ross Mayfield, investment strategy analyst at Baird. Ross, thanks so much for being with us. Talk to us about how you see the rate situation play out and why it's so volatile from not just week to week, but literally day to day.
I think a few things to unpack. I mean, first, when you have multiple, Fed governors or FOMC members speaking every day, and they're bound to have disparate opinions on the path of policy, you're going to see these moves in the Fed fund futures market. And we've seen it over this last week has been a great example. So a couple hawkish early in the week, then a couple more dovish yesterday, along with some reporting from some insiders on what the Fed is planning to do in June. I think you're also at a critical moment where inflation is still high, and for some Fed governors, that's enough to keep raising interest rates. Others are looking more at the larger trend, which show it heading down, and particularly if you use real-time housing data. So very volatile for sure. I think the important thing is that looking out towards maybe December or year end, Fed fund futures haven't changed that much over the last week and are starting to remove most of those rate hikes that had been priced in earlier this month. And for most of the year, really, we're looking at kind of the raise and hold mantra that the Fed wanted to get to. The market is coming around to what they've been saying. So I think that's maybe the more critical thing to look at is where are rates expected to be in December.
And I guess that's one part of it. And what will that mean for the overall market, which has held in there, albeit thanks to a small concentration of stocks. But is that significant that there hasn't been a major breakdown? We're still managing to hug that kind of 4,200 level? I think we lost Ross there. We're getting him back. Okay, well, while we try and focus on that, let's take a look at a one-year chart of the S&P 500. Some are taking comfort in the fact that, we are holding on to the gains that we have made since the March low. We haven't fundamentally broken down from that 4,200 level. It is acting as like a little bit of resistance. Now, the caveat to that will be it's just been a few stocks that have taken us there. We heard from Eric Green earlier this morning that he can't recall a bull market that began with such narrow concentration. Most other sectors have been under pressure. And then it begs the question, well, what is it going to take for that to broaden out? Certainly the economic data has not been supportive on that front. If you take a look at the retailers and what they're saying about the state of the consumer. Ross, I think you can hear me now. I'd like to bring you in on that point. We've had, headline resiliency in the overall market, but largely driven by one subset. Does that make you nervous?
It does and it doesn't. I think all things equal, you'd love to see a much broader rally, right? It's an indicator of the health of the economy, of the health of the overall market. But at the same time, concentration, and we're seeing pretty much as extreme as it's ever been, has not been an indicator of negative forward returns. So we'll take it as it is. That's kind of the nature of market cap weighted indices. But all things equal, we'd love to see a broadening out of this rally. I do think, to finish what we were talking about earlier, I think the resilience in the face of all of the headwinds, and if the Fed is able to hold interest rates high for the remainder of the year, is actually a bullish signpost for the economy. There were years where we weren't sure if the economy could handle coming off 0% interest rates. We've seen some cracks along the way as we've gone from 0 to 5%. But I think the resilience of the economy and markets in the face of that is actually a little more bullish and not as bearish as might be expected.
Can I ask you about one sector that certainly hasn't been as sexy as tech or artificial intelligence, but that is just doing its darndest to hold in, and that's industrials. It hasn't given you much performance so far in 2023, but it has not fallen out of bed either. What is that saying to you? Is that an area that is kind of perking up your interest?
I think so. I mean, yeah, but put tech aside, which is all anyone wants to talk about right now. But I think industrials, in the face of a widely expected economic slowdown, whether it's a soft landing or a hard landing, it is a landing. Industrials, which are as cyclical as they come, have held in there quite well on a cap-weighted and equal-weighted basis. And they have some really strong structural drivers behind them, whether it's federal spend on infrastructure or the kind of reshoring, nearshoring of supply chains. I mean, those are multi-year, decade-long runways for that theme. You're also seeing an uptick, and we expect to continue to see it globally in aerospace and defense spending as deglobalization kind of takes hold. So I think there are some structural drivers, and then in the short term, we love that it's kind of held in there, to your point, despite what looks like a cyclical downturn in the economy. That resilience is something to hold on to.
So the contrarian view would be it's held in there, and so it's not adequately pricing in any kind of downside scenario.
I think a cyclical downturn, you could see more downward pressure, right? So energy, materials, industrials, if we were to go into a hard landing or a true recessionary scenario in the next year, you'd see weakness out of those stocks almost certainly, as companies tighten the belt, as manufacturing goes deeper into contraction. But I do think its resilience in the near term, paired with some long-term structural themes, is something to get really excited about. And, again, has not run away from us like tech has, and can be had, some really strong names at fairly attractive prices.
Sometimes when you're making these kind of cyclical calls, they go hand in hand with other sectors like financials, for example. And indeed, typically industrials and financials tend to track each other because they're so cyclical, except in 2023. Specifically March 2023, things started to fall apart for financials. Is that an area that you would be looking to maybe recapture some of the delta? Are financials interesting to you at all, given how much they've decoupled from industrials?
I think it's interesting, but I think you need to have a high risk tolerance for that trade. I mean, we saw kind of a stoppage in the banking crisis, and then all of a sudden with First Republic, it resumes. No matter how cheap valuation gets, it can get cheaper. And so, the regional banks in particular, but even the bigger banks, face deposit outflows. They face difficulty with assets on their books and higher rates. And then broadly, because the FDIC stepped in and helped, they're facing higher assessments and, regulation going forward. So it's a sector where I think the valuation makes it attractive, but only if you can stomach, a pretty high risk tolerance in the near term. And then longer term, there are going to be earnings headwinds from, higher assessments from the FDIC. Congress is going to be watching the sector. Whenever big banks fail and put consumer deposits at risk, it gets on their radar. So I would worry about that a little bit.
All right.